right, welcome back to the Know Your Numbers REI podcast. Your host, Chris McCormack here, where we are discussing the latest development in all things taxes. Up to this point in the show's brief history, we have helped bring insights to you, the American taxpayer, the business owner, the entrepreneur, focusing a lot on real estate investing and how you can go from being frustrated with the amount that you pay in taxes to being very confident that you are saving the most you possibly can in taxes. And that is still our goal here, is to eliminate any confusion and frustration that you might feel, surely eliminate the overpayments that you've been dealing with. But also today and in previous weeks and in upcoming weeks, we're talking specifically about the latest development in the tax world, which is the proposals for tax changes, also known as the One Big Beautiful Bill. Last week we talked about the taxes or no taxes on overtime and what that would mean for you, the one making overtime, and what it would mean for you, the business owner. Today we're going to be focusing again on the business owner and the real estate investor, the entrepreneur, because we're going to be talking about what's known in the industry as the Section 199A deduction. Some others know it as the QBI deduction. You might not even be aware that this is available to you or that you might be receiving it. And so we will unpack what current law says and then what the provision for this new law is. Again, we're recording in June 2nd, 2025. So right now it's passed through the House of Representatives and it's at the doorstep of the Senate. They're currently having discussions and we'll be voting on it. I think the goal is to pass it by July 4th, or at least come to an agreement by July 4th. And so when you're listening to this, if it's passed, great. What we're saying is now fully enacted, and if it has not passed, just know this is what is being recommended and what could be law if it meets a majority vote in the confidence. So let's get to it. QBI, Qualified Business Income Deduction, also known as the Section 199A Deduction. What is it? It came into effect in 2017 when President Donald Trump was in his first term, and they came through with the biggest tax overhaul that we've seen in 40 years since President Ronald Reagan. Back when Reagan was president, they passed a big tax law that included things like real estate professional status. It included passive activity, loss limitations, and some other details that really stimulated the economy in the 1980s time period, and Donald Trump followed in his footsteps, passed the tax law through the help of the Congress at the time, and there was an economic growth in 2016, 2017, 2018, 2019, and then obviously we all remember, assuming you're not 5 years old, that COVID-19 was a thing and that the economy kind of plummeted. And if it weren't for that, there's reason to believe that the economy would have continued growing and that this tax law that was passed in 2017 would have been a great facilitator of that. Well, a lot of these 2017 tax laws were temporary in nature. They expire in 2025. But one part of that was this qualified business income deduction, which said if you meet certain requirements and thereby qualify for this deduction, 20% of your business income, 20% of your qualified business income comes to you as a deduction. So if you make $100,000 and you are qualified under the guidelines put forth in that law, then rather than being taxed on $100,000, you are now being taxed on $80,000. So it's this beautiful thing where you get a deduction that you didn't actually pay for. It's similar to depreciation, right? We've talked about depreciation on this show time and time again, and how it's a deduction that you don't actually pay for because we finance a lot of our properties with debt. And we take loans out to pay for these properties, but the Internal Revenue Code allows us to take depreciation, which is an expense that accounts for the wear and tear of a property. Real estate is a type of asset that tends to appreciate. And so it's this beautiful deduction that real estate investors can take advantage of without having to pay for anything. And so this QBI deduction is very similar in that regard, in that you don't have to pay for anything, but when your taxes are done correctly, when you're working with a qualified professional, chances are you're going to get this qualified business income deduction, and $20,000 of every $100,000 you make is no longer taxable to you. All right, so there's a summary of it. The current law states that an individual generally may deduct 20% of qualified business income from a partnership, S corporation, or sole proprietorship, as well as 20% of certain real estate investment trust, dividends, and publicly traded partnership income. The deduction is limited to 20% of taxable income minus net capital gains. Special rules apply to taxpayers with taxable incomes in excess of the threshold amount, which for the tax year 2025 is $394,600 for married taxpayers filing jointly and $197,300 for all other taxpayers. So that's another key point of this qualified business income. Again, this is under current tax law. I haven't gotten to the new law yet. This is under current tax law, the law that is expiring through tax year 2025. If your taxable income as a married individual filing jointly is greater than, call it $395,000, you get phased out. And if you're single, you're at $197,000 of taxable income, you get phased out. Right? So it's not just because you make income, just because you're a business owner that you qualify. There's these phase in and phase out stipulations that you have to account for. How do you plan around that? Well, if you know that you're on the fringe of making $395,000 as a married filing joint taxpayer, then you should be working with your accountant to say, okay, what are we going to do to get this taxable income down so that we can also qualify for the QBI deduction? This is what's known as planning around qualified business income deduction. The last part of this current law says the deduction for qualified business income is set to expire for taxable years beginning after December 31, 2025. If this big, beautiful bill does not pass, we no longer get the QBI deduction. We no longer have 20% of our business income as a deduction on a personal income tax return, and we pay 20% more in taxes. We don't want that. We want this tax to be made permanent, which is exactly what this new big beautiful bill is recommending. It's also recommending that it be increased. That is music to our ears. This provision makes the deduction for qualified business income permanent. That is beautiful. It is big and it is beautiful, right? There's no longer any worry that what we're currently paying is going to increase because the people in DC forgot to put a permanent restriction on these tax benefits that they're providing us. Currently, we don't have a permanent tax deduction. If this bill passes, we have a permanent tax deduction. The benefit is right there. 20% of your business income deduction, which if you've started your business after 2017, you're not used to paying 20% more in taxes. You have been in business since this law has been passed, and as a result, you've been working under a very beneficial tax environment. What you are currently realizing in tax savings through the qualified business income, assuming things are being prepared correctly and you're working with a qualified individual, which is a big assumption, but let's just assume that, means that you have been getting a 20% deduction on your taxes every year since starting your business. Now, what have you been doing with those savings? Who knows? You could be storing them up in a bank account. You could be investing them in your business. You could be investing them outside your business. You could be putting them into real estate. You could be putting them into crypto. You could be paying yourself and going on vacations. Whatever you're doing, that is no longer going to be the case if this law does not pass. That is something that we should be concerned about. However, the new law says that it's going to be made permanent. That is beautiful. That is good. That helps us as business owners because it gives us an immediate savings and we don't have to worry about it expiring. I enjoy that. You enjoy that. We want that to be the case. But that is not all. But wait, there's more. This provision for taxable years beginning after December 31, 2025, this provision also increases the deduction percentage from 20% to 23%. What was 20% goes up to 23%. It is made permanent. Now, every $100,000 you make up until you get phased out is also a $23,000 deduction. That is amazing. You don't have to spend $23,000 to save at least $5,000, $6,000 on taxes. You get it automatically, permanently. This is a good thing. Now, people who are not looking to approve this as it currently stands, again, I made note of this in my first episode. I listened to Senator Ron Johnson, who's from Wisconsin. He has an accounting background. He's a numbers guy. He is very concerned with the debt of the United States, and I don't blame him. It's very high. However, he is not in favor of the current tax law because he doesn't think it does enough to address that debt and the deficit that we're dealing with and the amount of money that we're spending. The plus is that if this passes, we get $23,000 for every $100,000 made as a deduction that we don't have to pay for. The downfall is that some believe that it's going to have negative repercussions, negative consequences to our currently ever expanding national debt. Now, somebody like President Trump would probably say we're going to make up for it in the use of tariffs. However, Ron Johnson would say that President Trump in his first term spent a large amount of money more than what they brought in revenue. That is an economic conversation that I'm not going to have outside of what I just went through. What I am going to say is that this qualified business income applies to partnership, it applies to S corporations, it applies to sole proprietors, it applies to real estate investors, entrepreneurs, tradesmen, accountants, people outside of the specified service trade businesses, which is a whole nother topic. It is most of you that are listening to this podcast, you qualify for this. Now, before you go and take that to the bank, you want to verify that you're not in that specified services, trade, or business. And you also want to make sure that you are 100% accurate on that, because we have seen many people have their taxes prepared and the accountant assumed they were an SSTB. That's what the short form of specified service trade business. The accountant assumed they were an SSTB, but upon further insight and discussion with the client, it turns out that they don't actually qualify and that they actually qualify for the deductions. I mean, there are big savings to be had, and it's important for you, the business owner, to be 100% sure and confident that you are either getting it because you qualify, or 100% sure that you don't qualify and it's okay that you're not getting it, right? So meet with somebody to discuss that. Now I'm just going to assume that most of you listening qualify. If you're a C corporation, you don't qualify. You might be messing around with the wrong entity. But if you're an S corporation, you're a partnership, you're a sole proprietor, you probably qualify. And now we're looking at a 23% QBI deduction if this passes through the Senate. That is good. What do you need to know as the business owner? You need to know that there are phase-out limits. I told you about the 395,000 married filing jointly, 197,000 or thereabouts as a single filer. If your taxable income is greater than that, you are going to be phased out and you're not going to get this deduction. That requires planning. That requires looking into how much you're taking as a salary, how much you're taking in profit. What can you do to reduce that profit? Can we make use of things like cost segregation, depreciation, investing in equipment, retirement account contributions, employee benefit plans to lower that amount so that, okay, we're keeping money in our accounts, we're making investments that are beneficial for our business and our personal wealth, and we're also saving more on taxes because we planned, and now we get a 23% deduction in the form of QBI according to section 199A. These are discussions that you should either be having with your accountant or making sure that your accountant is aware of. We have worked with many people on this deduction, and it has saved hundreds of thousands of dollars over the past 4 years that we've been in business, probably even $1 million at this point. I mean, if you make a profit of $200,000 and you get a 20% qualified business income deduction, that is a $40,000 deduction. That is $10,000 in tax savings. At least, that's like a conservative, that's a 25% tax bracket, which doesn't exist, but we can take the 24% and say that it's close to $10,000. You do that for 100 clients and that's $1 million, right? So it doesn't take much to save that much through this one strategy. So you, as the business owner, need to be aware of the QBI deduction, because the savings are increasing. 20% to 23% turns what was $10,000 to about $11,500, right? So an extra $1,500 worth of savings as a result of this increase, and it's made permanent. You don't have to worry about the tax changes and this being ripped out from under you like we currently have to under the current law. Because if this goes out of effect and this law does not pass, we're dealing with QBI deduction not increasing, not being made permanent, but being removed. And that's an extra $10,000 that you can expect to pay in taxes at that income level that I was just discussing. So what do we do about that? Well, then we have to plan and use the other strategies that are available to us. If you're in the real estate space, making use of depreciation, assuming you qualify for real estate professional status. If you're in the medical space or another one of these spaces that might have potential equipment investments that you can make, how can we invest in that so that we get depreciation and can save on taxes to offset the increase that we're going to see in QBI? I think at the end of the day, the most important conversation that we're having is the one that we're having, and that is the fact that these changes are no small change. It's a swing of $11,000 at least at that dollar amount, right? And it changes depending if you're in multiple businesses. It changes on your income level. It changes what industry you're in, but you can assume that this has massive implications on your business, on your taxable income, on your personal wealth. And we want to make sure that we're doing everything we can to be aware of the changes, to plan for the changes, and to make the most of the changes. And whether it goes through or doesn't, there are things that we need to be aware of and plan for and adapt to, really. Because if it goes away, it's going to require a lot of adaptation. If it increases, we can celebrate, but we also want to make sure that we're planning ahead and making use of everything that's available to us by considering how much money we're making. Is my accountant working for me? Does he know about this? Does he know that it's increasing? Does he know whether I'm an SSTB or not? Like, these are things that you need to be aware of. You need to be thinking about. And if the answer to any of those is no, well, you should find an accountant who's working for you, staying up to date on tax law, aware of these changes, and already thinking about how he's going to apply some of these changes to his clients' lives. If you got any sort of value out of this, if you know of anybody who might enjoy this or it applies to, again, these are business owners from real estate to doctors to contractors to landscapers. This applies to just about any and everybody. And so you could really bless someone by sharing this and by letting them know that these things are coming and it's good to be prepared. Until next time, God bless you and keep moving forward. We'll talk to you soon.